Hey everyone, and welcome. Today we are diving into the golden rules of investing. Think of this as your friendly roadmap, a straightforward guide to making smarter decisions with your money so you can hit those financial goals, whatever they might be.
That's really what it all boils down to, isn't it? It's not some magic formula or trying to get lucky with market timing. It's all about making informed, smart choices. The real key here is that your success, well, it's largely in your hands.
So, here's our game plan. We've broken this whole journey down into 6 simple steps. We're going to start with getting yourself ready, then we'll get into risk, research, diversification, thinking long term, and finally, why it's so important to review and adjust as you go. First up, rule number 1. Are you actually ready to invest? This is all about building a rock-solid financial foundation before you even think about putting a single dollar into the market. This is the first, and honestly, the most important question you have to ask yourself. We all hear about starting early, which is great, but jumping in before you're financially stable, that can really backfire. So let's talk about what that stability actually looks like. Think of this as your pre-flight checklist. First off, build an emergency fund that you can get to in a pinch. This is your safety net, right? So you're never forced to sell your investments at the worst possible time. Second, get rid of any high-interest debts. I mean, the return you get from paying off a credit card is pretty much always going to be higher than what you can reliably make in the market. And this is a hard and fast rule. Investing with a credit card is just a recipe for disaster. The crazy high interest rates will almost certainly wipe out any gains you might make. It is a risk that is just not worth taking. Period. Okay, let's move on to our second golden rule: know the risk and return. This is all about setting realistic expectations for your money right from the get-go. This right here, this captures the fundamental trade-off in all of investing. If you're chasing those high potential returns, you've got to be willing to accept a high level of risk. There's just no way around it. Figuring out where you're comfortable on this scale is the key to building a portfolio that actually lets you sleep at night. This is some timeless advice for sure. You have to be super cautious about any investment that's promising huge returns with little to no risk. As our source material warns, these are often just scams designed to take your hard-earned money. And beyond the big picture, it's the little details that really matter. Always check for hidden charges and fees because they can seriously eat into your profits over time. Set a realistic target for your returns, and if you do decide to dabble in high-risk stuff, you have to be 100% prepared for the possibility of losing that money. Okay, let's dive into rule number 3. Understand your investments deeply. When it comes down to it, your most powerful tool in this whole game is good old-fashioned research. So, before you commit your money, you gotta hit pause and ask yourself, do I really, truly know what I'm getting into here? Let's look at the specific questions you should be able to answer without even blinking. Here's a super practical checklist for your research. Can you clearly explain the level of risk involved? What outside stuff could mess with its performance? How quickly can you get your money out if you need it? And this is a big one. Is the firm you're using properly regulated? If you're a little fuzzy on any of these, that's a sign to hit the books again before you invest. All right, let's move on to our fourth rule, and it's a classic for a reason. Diversify. This is your safest bet for spreading out your risk and protecting your hard-earned capital. It's an old saying because it's true. Don't put all your eggs in one basket. Putting all your investment money into a single stock or asset is just a massive gamble. I mean, if that one thing goes south, you could lose everything. Spreading things out is your best defense against that happening. So what does diversification actually mean? Well, it's about spreading our money across different companies, different kinds of assets, like stocks and bonds, and even different parts of the world. The goal is simple. You don't want to be relying on any single investment to do all the heavy lifting. Our fifth rule is all about shifting your mindset. Play the long game. When it comes to investing, time is your single greatest ally. So what do we mean by long term? Well, the general recommendation is an investment time frame of at least 5 years, if not more. This gives your investments enough runway to ride out all the inevitable ups and downs of the market. Honestly, trying to perfectly time the market is a fool's errand. Even the pros have a tough time with it. It usually just leads to emotional decisions. Panic selling when prices are low and buying out of FOMO when they're high. A long-term, patient approach helps you tune out the noise and avoid those common traps. And that brings us to our sixth and final rule: review, realign, repeat.
See, investing isn't a set it and forget it kind of deal. It's an ongoing process of making sure your portfolio still makes sense for your life.
So, why is this so important? Well, life changes, right? As you can see here, your personal situation might change. Maybe you get a new job or start a family. Your long term goals might change too. And of course, the performance of your different investments is always going to be changing. Regular reviews just keep everything in sync.
Which leaves us with one last really important question for you to think about. Take a good look at your own investments right now. Are they still lined up with who you are today and who you want to be tomorrow? Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.